of ITC. Often we come across a lot of queries when we are dealing with multiple clients, ITC milega, nahi milega, and there are a lot many things in our mind. So will definitely give us a lot of insightful knowledge on the same. So yes, we'll have a Q&A quickly at the end. So first let him first finish all his entire topic, and then we can quickly have the questions at the end. So I'll quickly take an opportunity to introduce him. He's chartered accountant with 18 years of post-qualification experience. He's previously worked with Big Four, EY, Lakshmi Kumaran, Sridharan, Attorneys, BDO, and other companies. He has worked extensively on service tax, VAT, central excise, customs, FTB, and SCZ regulations. Since introduction of GST, he has helped various domestic and MNCs in GST implementation projects. He has handled complex GST advisory and litigation projects. He has contributed in n number of magazines with different forums along with ICI. So it's indeed an honor to have you here, sir. Now I request our branch chairperson, Amrita ma'am and Rajesh sir to kindly facilitate, sir. Over to you, sir.
My name is Amit Agarwal, and the topic today I have been asked to take up is evolving landscape of GST input tax credit and key case studies. So I was little confused or pondering about the timing of the session. It was told 12 to 2 p.m. So being a typical Puneri, generally पुणेरी लोक 12 ते 1 मध्ये लंच घेतात आणि लंच घेतल्यानंतर किमान अर्धा तास तरी झोपतात. तर जेवणाच्या आणि झोपण्याच्या मध्ये हा सेशन आहे. बट आय थिंक द ऑर्गनायझर्स आर स्मार्ट इनफ टू कीप दिस टॉपिक ड्युरिंग दिस golden hour, because I think most of the chartered accountants have lost their appetite and sleep because of the kind of litigation and disputes that are happening in the domain of input tax credit. So just to directly start the topic, so if you see what is happening today, that the GST revenue is increasing day by day. Like in March 24, the collection was yeah, so if you see in March 24, the GST revenue is almost 1.78 lakh crore rupees, and the collection of last financial year is almost INR 20.18 lakh crore rupees, and it is surpassing the budgeted estimate. Having said so, there is a lot of while the GST revenues are growing, there is another menace which is getting means the government tax administration is facing, is about fake invoices and hawala transactions. So if you see, as per the latest Press Information Bureau report of 7th January, the government has identified almost 29,000 odd bogus firms who are non-existent and are engaged in issuance of fake invoicing. And they are suspecting that there is a ITC input tax credit evasion of almost suspected evasion of almost INR 44,000 crores. And they are now doing nationwide drives to unearth these fake transactions and hawala transactions. and almost more than 100 arrests have also been made of these Hawala dealers. So this is the main issue why we are seeing so much of challenge in the input tax credit provisions, because the government is little unclear or not able to understand how to manage this menace, and they are tightening up each and every provision, and it is not happening on the day zero. Like, it didn't happen on 1st July 2017. Slowly, in bits and pieces, they kept introducing newer and newer provisions, sometimes by way of rule, sometimes by way of amendment in the act, sometimes by issuing some clarifications, and that all is creating a lot of challenges in terms of interpretation of GST input tax credit provisions. To be very honest, I have been handling input tax credit of GST since 2017, but yesterday again, when I was preparing for this lecture or seminar, I myself got confused with so many judgments. Every judgment is saying something else, and there are contradictory High Court rulings. So which way we advise for the taxpayer to sway is at times very challenging. There are very lot many open issues still, and I would in the case studies, if you see, I have selected some of the case studies which I felt is relevant for today's discussion, but I cannot cover everything under the domain of input tax credit in today's discussion. But let's see. So typically, if you see, there are so many. I'm sorry, I think the laptop has changed, so the alignment also has changed of the deck. If you see, typically any company is nowadays facing multiple levels of investigation. It is like DGGI, SERA, then inspection is happening, routine ASMT 10s are being issued, audits have been initiated, and post that ADT 1 are issued, show cause notices are there. Then there is duplicate proceeding which is happening, like some assessees are under domain of state. Since center is doing some investigation on a particular financial year which is already being investigated by the state or vice versa. And plus now a new menace has been added is this automated notices of DRC 01C, where moment there is a difference between 1 and 3B, and there is a difference in 2A and 3B, automated notices are being issued which we have to reply. So the point here is with the menace of fake invoicing, and the government is suspecting that there is a lot of revenue loss, they are going full throttle, and they are trying to squeeze as much as possible. But in the bargain, the genuine taxpayers are also suffering. So I'm just taking a bit into the history, that how the current ITC provisions are coming in existence, or this we have analyzed even in GST regime. But quickly, if you see, the SENVAT credit regime or the SENVAT credit rules 2004 never had any such provision that if the vendor has not paid the tax, the credit would not be allowable to the recipient. The provisions under the central SENVAT credit rules were very clear that if the transaction is a bona fide business transaction, if I have received the goods and services, and if I have a valid invoice, then my SENVAT credit was never disallowed. But if you see, in contrast, in VAT regime, they had provisions across all the state VAT acts to say that if the tax is actually not getting deposited in the government kitty, then they are not going to allow the input tax credit or VAT set off to the taxpayer. And therefore, when the GST was getting implemented, the center was not in favor of having any such provision which says that tax will be input tax credit will be allowed only if the government is getting revenue. It is the state, multiple state governments pressure the center government had to bend down, and that is how we are seeing the current day section 16, and to be more precise, section 16 to subsection C, which says that the credit would be allowed if the tax is actually paid by the supplier to the government. Now, in this context, if you remember, under Maharashtra VAT Act, there was this section 48(5), which is similar to our section 16(2)(c) of the CGST Act. So there also, the Maharashtra VAT Act had specified that they will not, the government will not allow VAT set off or MVAT set off to the taxpayer or the recipient if the vendor from whom he has purchased the material has not actually deposited the tax to the government kitty. And this provision of section 48(5) of MVAT Act was challenged by the assessee in the case of Mahalakshmi Cotton Ginning and Spinning Mills, and the matter went to Bombay High Court, and unfortunately the decision was pronounced against the assessee in favor of the revenue. And this judgment rather is one of the major culprits, because the VAT authorities felt very overpowered by this High Court judgment, which in a way allowed them to recover the set off from the honest taxpayers, in spite of they doing their own duty of collecting the tax from defaulting sellers. They found that trapping the innocent buyers will be much more easier for them. So this Mahalakshmi Cotton Mills in a way allowed the judgment in favor of the revenue. In contrast, there is this Arise India Limited case, which is similar to Bombay High Court case of Mahalakshmi Cottons. There, under Delhi VAT Act, erstwhile Delhi VAT Act, there was section 9, subsection 2(g), where a similar provision like section 48(5) was there, and there they were saying that such class of vendors or customers who are procuring goods from the suppliers and that is not getting deposited, set off will not be allowed. So here the High Court ruled in favor of the assessee. I am going to take both these judgments in detail, because these kind of judgments are in a way giving us the genesis of how to interpret section 16(2)(c) and other clauses under section 16 of the GST Act. So if you see, the government mindset is very clear that if they are getting the money in their pockets, then only they are going to allow the input tax credit. If they are not getting the money in their pockets, then they are straight away going ahead and denying the ITC to the honest taxpayer. So if you see, now I am going to discuss little bit on Mahalakshmi Cotton Mills and what Bombay High Court in a way had observed while passing this significant judgment. So here, as I mentioned, High Court had upheld the constitutional validity of section 48(5). The High Court observed that the primary responsibility to pay VAT is that of the seller, and we cannot say that the tax which the purchaser had collected from the seller on the procurement has been collected as his agent or agent of the government, and therefore once the tax is paid to the vendor, the partial liability has been discharged. So this kind of argument was nullified by the Bombay High Court. Then the High Court said that this provision has been introduced, that is section 48(5), for removal of doubts, and it had contained a legislative declaration to the effect that in no case would the amount of set-off or refund on any purchase of goods could exceed the amount of tax actually paid. And the purpose of set-off was to obviate cascading effect of tax burden. This so if the government is saying, if there is no money which I have received, rather High Court had said that if they have not, government has not received the money in its coffers, then there is a burden on the government, there is loss of revenue, and they cannot eliminate that cascading effect of tax. And the High Court also said that set-off is a concession, but that is within that 4 parameters. Like if you see under central excise, we had this judgment of Eicher Motors, which is very celebrated judgment and of central excise, where the Honorable Supreme Court had held that VAT credit is a vested right. Okay. So once it is a right, then all other conditions were little looked at more of procedural or more on diluted note, to say that once that right has to be given, then other things like tax not paid by the vendor or the claim not filed in time could be overlooked, and this vested right has to be honored. But in this case, the High Court has said that it is not an unfettered right, and that concession has to be honored subject to satisfaction of all the conditions mentioned therein. And the word actually paid is very plain and simple. And here the taxpayer Mahalakshmi Cotton Mills was arguing that actually paid should be interpreted as ought to be paid. That is, whatever was supposed to be paid, that credit should be allowed. But High Court said no, actually paid means actually deposited in the government kitty. And one more important thing here, it was argued by the assessee that there is no ways and means available to the recipient to identify whether the vendor has paid or deposited the tax to the government. So how I would satisfy that? Once I receive the tax invoice, once I have received the goods, and once I have paid the invoice, that much is sufficient, to prove my set of claim. But unfortunately, this argument also didn't sail through before the Bombay High Court. And one more important observation is that Sales Tax Department had filed affidavits before the Bombay High Court, and Bombay High Court in this case said that these affidavits or the promises which the state government and Sales Tax Department have made to the High Court should be honored in reality. So what the Sales Tax Department or Maharashtra government had said or filed the affidavit is that they will definitely not give the set off in case it is not paid to the government, but moment it is recovered from the end from the supplier, then they may allow refund to the recipient, and there need not be any separate application, and within the available machinery they will grant the refund. So the argument of double taxation would not, the case of double taxation would not arise, that I have paid to the vendor and that set off again I have to pay to the government. So as a recipient I am paying tax 2 times. So the government or the Sales Tax Department promised to the Bombay High Court that they will not do such double taxation, and moment they recover on pro rata basis they will give refund to the recipient. But practically, have we seen any such case? No. So they have themselves made the promise and U-turned on their promise. Okay. When I as a taxpayer I file the return, I file an undertaking that whatever I am saying is true and correct and whatever. But it is a public domain, judgment is there where the government itself has filed an affidavit that they will do this. But in reality, nothing as such has ever happened. So this is something very important. This is the case of Arise India. This judgment is a favorable judgment by Delhi High Court, and an SLP was filed, specially petition was filed before the Honorable Supreme Court in this case, which was dismissed. The department had filed SLP, which was dismissed by the Supreme Court. In a way, the judgment has been upheld by the Honorable Supreme Court. So here again, the dispute was about disallowance of VAT set off under Delhi VAT Act under the provisions of 92G. And the question that was posed to the High Court is that whether for the default committed by the selling dealer, can the purchasing dealer be bearing the consequence by way of denial of ITC, and whether this section is violative of Article 14 of Constitution of India. And the said section, as I mentioned, said that set off would not be allowed to dealers or class of dealers unless the tax paid by the purchasing dealer has actually been deposited by the selling dealer. So the High Court here read down the expression dealers or class of dealers, and they said that the dealers or class of dealers means it should not include genuine and bona fide purchasers who are doing valid procurements based on tax invoice, paying through banking channels, receiving the goods. Such dealers are not covered in ambit of 92G. What is covered is people who are engaged in Hawala transactions and in collusion with the seller, they are trying to evade the tax or trying to claim bogus set off. So the High Court in this case had read down the provision of 92G in this manner, and they said that set off cannot be denied to the bona fide purchasing dealer and it could be recovered from the defaulting dealer. And there is a provision of section 40A under the erstwhile Delhi VAT which can be invoked to recover that tax from the defaulting dealer. So these are very two important judgments if you see, and I think if we are reading section 16 of the GST Act, we can always go back to these two judgments, and Arise India has been referred in some of the favorable judgments even under the GST Act. So if you see the evolution of the GST input tax credit provisions, there has been an amendment every time. At times you also lose a track of what amendment was made and when it was made and why it was made. So I have listed down some of the key provisions under the GST Act. So if you see, initially when the GST was implemented from 1st July 2017, the original plan was that there will be 3 returns: GSTR 1, GSTR 2 and GSTR 3. So as per the concept which was introduced, there would be a matching. So everybody will file 1. After 1 is filed, there will be auto population of credit in 2 and matching will happen. And once the credit is locked, then you settle the liability by filing GSTR 3. Because of the challenge of whatever technology or volume of clients, taxpayers data to be handled, GSTN never could implement this GSTR 2 and 3, and it was kept in abeyance for quite some time. Meanwhile, they said that you can take credit based on self-assessment basis. That means whatever is there in your purchase register, you can claim the input tax credit in terms of section 16. I have culled out some circulars also where the government itself has said that you can take the credit based on self-assessment basis. So nobody was doing matching. If you see in financial year 17-18, in fact 17-18 annual return itself got filed in March 2019 and nobody was clear as to how things are to be done. Even 18-19 went by, nobody was doing the matching. It is on 9th October 2019, suddenly the government introduced this rule 36.4 in CGST rules, which said that you can take credits subject to maximum, like whatever is matching, you can take full credit. Whatever is unmatched, whatever is pending to be matched, you can take credit, say 20%, then they made it 10%, and then eventually they made it 5%. So unmatched credit you can take up to 20, 10 or 5%. And this is when people realized the importance of statement GSTR 2A. So GSTR 2A finds mention in the rules from day 1. But actual data started coming in, or the 2A statement started being made available to the taxpayer somewhere in September 2018. So almost after 1.5 years of passage of time, 2018 GSTR 2A was made available. And if you see, GSTR 2A initially didn't had any 3B filing status. 3B filing status got introduced in 2A only somewhere in 2020, October 2020. So from a taxpayer point of view, to identify whether my vendor has filed 3B, that itself was not available. Now in October 20, if 3B filing status is made available, still I can't confirm whether the particular tax invoice which I have in my purchase register, whether the tax for that particular invoice has been deposited into the government kitty, because 3B is a summary return. So this 36(4) was introduced. Again, this rule itself is very annoying in that sense, because the calculations are at times very difficult. There is a circular also to compute how the 36(4) calculations are to be done. And but the point is that section 16 nowhere had any mention about this rule 36(4). In fact, section 16(2) is a non-obstant clause section, that is, it says notwithstanding anything contained in this particular section, they have identified certain conditions. So initially 17, 18, 18, 19, 19, 20, when this 36(4) was introduced, there is nothing in section 16 which supports this rule, which allows the credit up to 20%, 10% or 5%. Rather, to my mind, 36(4) is self-contradictory, because on one side we have section 16(2) subclause C, which says that tax actually paid only will be allowed as a credit. Now 36(4), which is a subordinate legislation, it is a rule. It is going ahead and saying, okay, you can take credit up to 20% of unmatched. That means the vendor must not have filed the returns. If he has not filed the returns, or particular invoice is not appearing in the return, then he may not have paid the tax also. It is like assumption that tax may not have been paid because the returns have not been filed. So how a subordinate legislation can override the section 16(2) subsection C and say, okay, you take the credit to the extent of 20%. Also, as I mentioned, section 16 is completely silent about this rule 36(4) during that period, and therefore this rule 36(4) itself has been challenged, and multiple writ petitions are pending currently before Gujarat High Court and Kolkata High Court. So we'll have to wait and watch as to how the courts are responding to the rule 36(4). Practically, so since it is a litigation conclave, we are discussing all the attributes which we can use to defend the pending cases, because now if you see, I have shown that circle of so many proceedings which have happened, which has led to so many show cause notices of high value, right? So department themselves don't understand how to do this two-way reconciliation. It becomes at times very daunting to explain them that this two-way, how this two-way reconciliation is to be done. I will take a particular format to them. They will say, no, you give me in this format. So they will keep giving me 2-3 different formats, and then it is difficult to explain them in their format, because their format is very clumsy. If we take a logical format to the tax officer, they don't want to understand that. I have taken the cases where we have given line item wise reconciliation of purchase register, and again each line of purchase register we have tagged the 2A month. So then there is no question of I have taken anything more than 2A. So whatever difference on summary basis you are seeing, it could be timing difference, it could be like 17-18 credit taken in 18-19 and 18-19 taking in 19-20. It can't be matching, because at times I take credit on payment basis. Some companies are going very conservative and they take ITC only when the invoice is paid to the vendor. So vendor may have reported the invoice in April. It may appear in 2A of May, and I may have taken in September. So these are the practical things. RCM credits, again, I may pay in April, I may take the credit in May. So if they are trying to reconcile all this, and that point of time import of goods credit was not appearing in 2A. So all those issues are there practically, and 2A is very dynamic statement, right? So I have done a reconciliation based on 2A downloaded from their portal only. But God knows from where in GSTR 9, that column 8A, there is an auto-populated figure that never matches with my 2A. So then they say it is not matching. You show me how it can, why it is excess. I said, sir, firstly I have relied on 2A, which is downloaded from your own portal. Second, 8A, even if I want to reconcile, that is a solid figure which is directly getting auto-populated in GSTR 9. So even if I have to reconcile and give you a transaction level, you give me backup of 8A, I'll show how it is wrong. So these are the practical challenges which we are facing in 2A, 3B reconciliation. Now they have gone one step ahead. Earlier we were receiving notices that 2A is less than what credits are there in 3B. Now we are getting notices that credits in 3B is less than 2A or 2B statement. तो कम ले तो भी प्रॉब्लम है, ज़्यादा ले लिया तो प्रॉब्लम है ही, बट कम ले लिया तो they are suspecting that there is a suppression of purchase and therefore there is loss of revenue probably. So I have to go ahead and explain them that why my 3B is less as compared to 2A or 2B. But that is how the law has evolved. Then and all these steps, you know, ये सीढ़ियाँ जितनी हम चढ़ते हैं उतना confusion बढ़ता है, and this confusion is going to help us defend our cases for at least 17, 18 till up to December 21. Okay, so this Jan 22 is a milestone because section 16(2) subclause AA was introduced, and it in a way gave a validation to rule 36(4). So rule 36(4) was replaced or substituted, and they said that credit can be taken only if it is appearing in statement 2B. Okay, and for the first time section 16(2) subclause AA included the reference, empowered that rule 36(4) by saying that credit can be availed based on the communication of the statement of the returns filed by the vendor, and this became mandatory from 1st Jan 2022. So if you see whatever mess is there in input tax credit, at least on matching side, it is only up to December 22 because December 21, because till that time people have taken credits based on self-assessment, or even if the credit is not appearing in 2A at times, they have gone ahead and taken that credit. So one more point is rule 36(4) at that time allowed ITC up to 20%, 10% or 5% of the match credit. So say if my match credit is 100, then I can take credit of unmatched credit up to say 10% in that month, then 100 ka 10% at 10. So to the extent of 10 rupees, I can take unmatched credit or which is not appearing in 2A as per their own rule. You have to take tax based on payment by the vendor. Of course, section 16(2)(c) is there, and we will see some of the landmark rulings as to how the courts have dealt with that section 16(2)(c). Everybody clear with this? I'm just taking the history because we are looking at the evolving landscape. So with this, like now we have 2B, we have automated credits which are there. If you see, there is a future to this evolution, and in the 40th GST Council meeting, Infosys had proposed that instead of rule-based allowance of credit, like based on the section 16 and CGST rules, there is always possibility of excess ITC or invalid ITC being taken by the recipient. So they had proposed a plan that there will be a three-way settlement. So when I am at the vendor's place and I am a customer, I am making payment to the vendor invoice. Moment the payment is made, that immediately will get credited to the government revenue, and there will be a settlement. How they will do, I don't know, because ITC is also something which they have to consider. But that was some plan. Even I have not understood how are they going to implement. But from future perspective, they are thinking of some payment gateway based on which the credits will be allowed. So we should wait and watch. It is an aspirational thing because still now whatever is there, still it is evolving, and government is finding, or the GST and portal is finding difficult to keep up the pace with the requirements, IT technology requirements.
Isn't it will be easy to do away with the ITC itself?
Yeah, so there was one of the articles I was reading. So if the government is not trusting the forward charge, they should bring RCM on everything. I will pay tax and I will take credit. Why have they put this forward charge thing? Yes, so those are the concept, but yes, right now this is the issue, and we should pray that everything should not be that simple, otherwise you and me will be out of business. So now I will jump to the key case studies. I have completed the evolving landscape of GST input tax credit. So if you see, we have come a long way from what we started the journey from 1st July 2017 to what we are doing today. And from here still we can see more tightening of norms, more technology being introduced. DGGI is implemented a lot of technology to unearth fake invoicing. What I was reading one of the articles, so there what DGGI is doing, they are seeing who has started the company. In 3 years the turnover goes up, and in 4th year the company is shut. So that DGGI director was telling me how practically is possible any commercial person whose business is increasing and suddenly they will shut the shop. So that is one of the red flags for them. They are analyzing the e-way data and seeing that there is a lot of turnover in the GSTR1, but there is no movement of goods which is happening. So with these RFID tags and the toll booth data, they are able to identify the movement of goods based on e-way system. And if they see that there is no movement of goods which is matching or attributable to the items reported in one, they are going to go ahead and catch those people. So a lot of investigations are happening nowadays on this side. So the first case study is Police Limited purchase goods from Chor LLP. I've just kept the name for fun purpose, but Chor is not like completely Chor. Maybe in certain aspects he might be Chor, and at times he may have genuinely supplied goods to me. So Police Limited had received the valid tax invoice, had received the goods also from Chor LLP. It has also paid the invoice including GST to Chor Limited through banking channels, and the invoice may or may not have been reflected in 2A or 2B. It may be reflected in some cases, it may not have been reflected in some cases. And then department has undertaken audit of Police Limited and have made following observations: that Chor Limited is involved in issuing fake invoices, bogus invoices, and it has also not deposited the tax in the government kitty. They have not filed 3B returns, and therefore they have pulled out the amount, and they are saying that this has to be reversed. So now the period of audit is 17-18 and 22-23. So they are asking for our opinion as to what is to be done. The client is asking that they have received this observation letter, and of course now they will get a show cause notice in DRC 01, and they want to reply. So they are asking our advice, what is to be replied to the department. So before getting into the case study, we will just cover some few more cases which are there from GST perspective. I don't know why the alignment is. So first judgment is a recent judgment of Kolkata High Court. It is of Suncraft Energy Private Limited. And the judgment in this case was that department disallowed the ITC as the vendor did not reported the invoice in GSTR1, and the tax according to the department, the tax charge was not actually paid to the government. So here the appellant submission was that there is no allegation by the department that the appellant doesn't, that is Suncraft doesn't has the custody of tax invoice. They are in possession of the tax invoice. There is no denial by the department that the goods were not received by Suncraft. Okay, and also full payment of the invoice with GST was made, and the assessee also relied on the press note of October 18, where the department itself has clarified that 2A is merely facilitator and it will not lead to automatically reversal of mismatch credits. This press note was also noted by Honorable Supreme Court in Bharti Airtel judgment, where Supreme Court also has observed that 2A is merely a facilitator and it is not and that is for the benefit or as a helping aid of the taxpayer. The credits have to be taken based on self-assessment mechanism, that is based on your purchase register. So in Bharti Airtel what had happened, that the assessee missed out to take certain credits, and because credits, and they ended up paying tax in cash, some 800 odd crores, and then they filed a writ petition before the Delhi High Court saying that because of non-operationalization of the 2A mechanism or the matching concept, they suffered this loss. And High Court agreed that because this mechanism of 2A matching was not enforced or not in vogue, the assessee has faced this loss and the refund should be granted. Department filed an appeal against this Delhi High Court judgment before the Supreme Court. Supreme Court said nothing doing. 2A statement is just a facilitator and the tax assessment has to be done by the taxpayer on self-assessment basis, and they dismissed the order and said that the refund will not be granted. So now coming back to the Suncraft, the High Court here has made following interesting observations, that department has not resorted to any action against the defaulting seller. So directly they came to me saying that the vendor has not paid the tax, now you pay it. So High Court said that you have not done what you were supposed to do. Then department ignored the tax invoices produced by the appellant as well as the bank statements. So that was an important thing. Therefore, before the High Court categorically said that before directing the purchaser to deposit that input tax credit, you should have gone after that defaulting seller. And if that defaulting seller could not have been caught, then you can come to the taxpayer. So they are saying cannot proceed against the company unless you bring out exceptional cases where there has been collusion, vendor is missing or vendor has closed down the business, or the vendor does not have any asset and such other contingencies. So in a way, if you see, people are reading Suncraft judgment in a favorable manner, but the observations of the High Court, Kolkata High Court, are very important to see that exceptional cases they can still come and chase me. Like there are cases where vendors have closed the business, or they could be Hawala transaction, that is so there, that they can definitely reach out to me. But if the vendor is not having the assets, if such kind of evidences are there, they can still come back to me saying that ITC needs to be paid. So it is not any blanket decision that in every case you should they can only go after the defaulting seller. And section they are not talking anything about section 16(2)(c), like how in Arise India, the Delhi in the VAT context, the Delhi High Court had read down section 9(2)(g). Likewise in Suncraft, they are not reading down section 16(2)(c), where payment of tax by the vendor in the government kitty is an important aspect. So these are certain things which we may have to keep in mind when we are relying on this judgment. Of course, in our reply to notices, in our show cause replies, we are relying on this, and in a way it may work in favor for assessees who are there in West Bengal, because a jurisdictional High Court decision in Bengal would prevail in that state. We have favorable decision in Bombay, in Maharashtra also, so we can leverage upon these favorable decision in Maharashtra. I will discuss one judgment of Patna High Court which is against on similar point. So, and good thing is on Suncraft, the Supreme Court has dismissed the SLP filed by the department. But again, Supreme Court has not dealt with the matter in detail. They are only saying that considering the amounts, small amounts involved and all that, they dismiss the SLP. There is not too much of observation on the merits of the case. So in that sense, whether it can be considered as a binding precedent in all cases is something to be watched out for. So again, there is this another important judgment of GST regime only, DY Bethel Enterprises. It is a Madras High Court judgment. So here the company had availed ITC in respect of a vendor. The facts are similar. The payment to the vendor was made by banking channel. The company had a valid tax invoice. Department found that seller has not paid the tax to the government and also was involved in issuance of bogus invoice. And department alleged that there was no movement of goods. Okay, but in this case, the taxpayer DY Bethel was telling the department, yeah, you bring that vendor in front of me, you do the cross examination of the vendor, because you are saying there is no movement of goods, you are saying that they are doing fake invoicing. So their statement also needs to be recorded, their cross examination also should happen, and I must be allowed that opportunity to do that cross examination. But department being department, this request was never honored, and they directly took the recovery action. They had not taken against the seller, but they took at the buyer. And the High Court said that when it has come out that seller has collected the tax from the purchasing dealer, the omission on the part of the seller to remit the tax in question must have been viewed very seriously, and strict action ought to have been initiated against him. So High Court is saying, if the seller has defaulted, it is a serious crime and you should have taken action against that seller, but instead of that you are recovering it from the purchaser, which is not correct. And the High Court also said the seller should have been cross-examined in this case, and the matter was remanded for fresh consideration. Again here 16(2)(c) was not challenged or read down, so it is not touching on that, but they are only saying that you should have gone back to the seller. So if I read these judgments in Arise India also, they read down these draconian provisions saying that only such buyers will be included in ambit of these restrictive provisions who in collusion with the seller are doing Hawala transaction. So a genuine taxpayer who like the facts in this case should not be brought into this, and that is I think the broader analogy of the High Courts when they are doing this. Again in LGW Industries, Kolkata High Court, here again the vendor was issuing goods which claiming the goods were purchased from the vendor who, as the department was saying, is fake and non-existing. The bank accounts were opened by the suppliers basis fake documents, and the petitioner claim of benefit of ITC is not supported by relevant documents, and petitioner has not verified the genuineness of the supplier before entering into those transactions. Now in day-to-day business, how do I verify that? Moment I see there is a registration, he is issuing the tax invoice, it is getting reported in 2A. Now whether he is ultimately paying the tax or not is beyond my control. And as I mentioned, till October 20, 3B filing status itself was not available in 2A. And even after 3B filing status is there, how can I guarantee whether he has paid the tax? So as a recipient, I don't have anything to say that whether the supplier has paid the tax or not. So petitioners here argued that they have paid the purchases through bank accounts. They are helpless. See the wordings. The petitioners are helpless if at some point transactions after the department found were fake and bogus, and petitioner could not be penalized unless department proves collusion. So if he's done 1,000 transactions, out of that my is a genuine transaction and remaining 999 transactions are fake, then department can't say that all are fake. If I am saying I have received the goods, instead of believing me, you are directly penalizing me for that, and the disputed invoices in this case were available in 2A statement, the assessee argued. So High Court held that if all purchases are genuine and supported by valid documents and transactions were made before the cancellation of GST registration, the petitioner shall be given the benefit of ITC in this question. So what department of late has started doing, if vendors GST registration is being cancelled, they are saying no GST credit. Array, but if I have purchased when the GST registration was alive, then how can you do that? Section 16 nowhere is saying that if the purchases are made from cancelled registrations, ITC cannot be taken. If all the conditions of section 16 are met, then how can you deny me the credit? Of course, 16(2)(c) is a different ball game, which we discussed in other judgments, that payment criteria cannot be in a way imposed on every assessee in that sense. So here again, similar, the registration was cancelled retrospectively, and the High Court said that engineering tool judgment, Madras High Court said that credit cannot be denied. Now, in contrast of the judgment what I was narrating to you, there is this Astha Enterprises Patna High Court 2023 decision, and there are a few others where the tax has not been actually paid to the government. That's why department denied the credit. And High Court said, so this is the judgment which is dealing with 16(2)(c), that substantiating the ITC claim would not absolve the recipient from the rigor of section 16(2)(c). So if you are saying goods are received, tax invoice is there, it is a bona fide transaction, still 16(2)(c) is there on the statute books and you have to satisfy that. And unless credit is available in the credit ledger of the purchasing dealer, ITC would not be allowed. Means government को पैसा ही नहीं मिला है तो वो ITC नहीं देंगे. तो similar to what Bombay High Court had said in Mahalakshmi, in a way is being I can see that is echoing in this Astha Enterprise judgment. And they are saying having regard to literal nomenclature and the statutory language held in clause A, B, C of section 16(2), it has to be scrupulously followed. So all these judgment clauses have to be followed in the spirit, and the conditions are to be satisfied together and not separately. Like I can satisfy one condition, I will not satisfy another condition. They are saying it is not allowable. All the conditions in section 16(2) are to be satisfied. And in this case, the department recovers tax from the seller. The purchaser, based on available machinery, could claim refund of ITC. Now there is no such machinery. What available machinery? We are not getting normal refunds which are covered in section 54. Now if I have to put this in others category under section 54 and claim the refund, then firstly I need to know that the department has recovered that money. After they recovered it from me, who will tell me and from where I will get that? And there will be hundreds of customers for that vendor. How much they have recovery made to the, which is pro rata to my input tax credit. That all that has to be made available. Like it is very easy for the judge to sit in the chamber and pronounce such kind of directions, but practically how it will get implemented is something one needs to understand. So if you see why I was saying that I myself was getting confused, because every judgment has some observation which is different from the observation of other high courts. And now high courts are confusing, like every high court has a different point of view on section 16, and maybe ultimately the matter will reach to the Supreme Court to understand how the credits will be allowed. Now anyways, we are in a litigation stage. During 17-18, 18-19 the mishap has happened. For the current months, we will not advise that. We will tell the client matching karo or credit lo. Matching nahi hai, usko agle mahine lo, and you should have clauses in your vendor contracts, and recovery, if at all credit get lapsed because of some time bar or anything, I will recover from the vendor itself. So many of my multinational clients, they have regular vendors. They have debited to the vendor accounts, but many of these times these issues are not by regular vendors. Those are like one-time vendors or fly-by-night companies, and especially in works contract and those kind of industries where local smaller vendors are taken, there this issue is predominant. So now I'm dealing with all these judgments, because then we will go back to the case study and how we defend that show cause notice. Now key circulars. So if you see this 26 of 2017 of December 2017, this circular clarifies, and I've culled out the paragraph. It says that since the GST Council has decided that the time period for filing of Form GSTR 2 and 3 for month of July 17 to March 18 would be worked out by a committee of officers, the system-based reconciliation prescribed under Circular 7/7 of 2017 can only be operationalized after the relevant notification is issued. The said circular is therefore kept in abeyance till such time. So the lawmakers themselves are issuing this circular that reconciliation is kept in abeyance. It is not possible at that time. And now for the same financial year 17-18, they are turning back and asking me that I should pay that input tax credit, which is very illogical. Then if you see 20th GST Council press release of 4th May, no automatic reversal of input tax credit. So the council meeting press note says that there shall not be any automatic reversal of ITC from buyer on non-payment of tax by the seller. In case of default in payment of tax by the seller, recovery shall be made from the seller. However, reversal of credit from the buyer shall also be an option available with the revenue authorities to address exceptional situations like missing dealer, closure of business by supplier, or supplier not having adequate assets. So what Suncraft also said. So this is the report was given by the group of ministers about the new returns which will come. And if you see, the mindset of the government is also that there should not be automatic reversal of ITC. Now the same authorities, same GST authorities are turning back and in a way asking me reversal when the provision itself was evolving at that time. Then there is a press note, the same press note also says that there will be 3 stages of transition to the new system. So they were discussing about the new GST returns. I have taken the observations from there. So stage 1 shall be present system of filing return 3B and 1. 2 and 3 shall continue to remain suspended. Stage 1 will continue for a period not exceeding 6 months. And once the 3B and all that is rolled out, during this stage 2 and 3 are rolled out, the dealer will be constantly fed the information about gap between the credit available and what is there in 3B. And after 6 months of this phase 2, the facility of provisional credit will get withdrawn and input tax credit will only be limited to invoices uploaded by the sellers from the dealer. So again here the council had thought of, or the ministers had told that you can take the credit on self-assessment basis or provisional credits, and up to 6 months of the new system you will be allowed to do that. But practically this never happened. Then this funny circular of 183 has been issued. Now what has happened for 17, 18, 18, 19, there were huge demands which are made for mismatches. So representation was made and in a way they have come out with this circular. There is nothing in the law which prescribes, section 16 or CGST rules talk about this, but this is like an administrative provision. So they are saying that up to 5 lakhs if the credit is there, you bring the self-declaration from the vendor that the taxes has been paid, it is reported, and if it is reported as B2C, it was B2B or whatever. Or if there is some other issue, it can be rectified. And if it is more than 5 lakhs, you take a CA certificate or a cost accountant certificate. But here again, taking certificate is painful. Many vendors are absconded, they are missing. Some vendors are there, but they are not ready to give any such declaration or a certificate. So practically it is very challenging, right? And as I mentioned, later on they extended benefit of this 183 circular to 1920 and up to December 21. And for 36(4) also they are saying you have to bring this declaration. And Rule 36(4), as I mentioned earlier, is nowhere saying that I have to reverse the credit later on if the vendor has not filed the return. But now, based on this circular, it appears that if I am not able to produce this, they are going to recover that 20% or 10% extra credit I have taken, which was unmatched. So, if you see, the law has evolved a lot, even if the evolution I have seen. So, at least for period 17-18, I have lot of ammunition to argue, and the judgments are there in my favor. 17-18, 18-19, even up to December 21. I can say that reconciliation was not mandatory as such. Okay. Means now, since we are litigation, I am suggesting that these are the strategies. We can rely upon these circulars saying that the credit was to be taken based on self-assessment. The reconciliation was not mandatory, and if there is a violation at the vendor's end, you should go back to the vendor rather than coming to me, and we can rely upon these various favorable judgments. And 16(2)(c) is a baby which again we'll have to defend in case it comes. Based on that idea is to, how it was in Arise India, that idea is to trap Hawala people and not genuine taxpayers. So this is how we have to defend these cases. And we can say that Rule 36(4) is not coming out from the Act. It is a subordinate legislation and it cannot impose any new condition on me. So this is how I can respond to 17-18, 18-19 and those cases. However, from 2020, means from Jan 22 onwards, the things are different, right? Now it is not self-assessment. Credit has to be taken by 2B statement. So you cannot argue that the credit was available based on self-assessment basis. Earlier, the High Court had relied on that 2A was optional. It was self-assessment. Now those arguments may not fly from Jan 22 because 2B statement is mandatory. So any such mismatch if is there, the case goes on weaker footing, except in case where vendors have not paid the tax, we can still go ahead and argue that the idea is to trap Hawala transactions and fraudulent vendors and suppliers, but not genuine taxpayer. So we'll have to wait and watch as to how this journey unfolds, because on one side we have Suncraft and another side we have Astha Enterprises, Patna High Court. So ultimately what Supreme Court says, we'll have to wait and watch. But at least I think from Jan 22 the things are little on the restrictive side, while arguments can still be made. Yes.
Sir, I have a case. Just regarding like this, I have a client who has I claim the ITC, and from the client who he has purchased, he has a notice regarding for May 22. The notice is like the client has not paid the the opposite party. For example, the police limited has not paid the GST after June 23. Okay, so and I have claimed the credit for May 22. So I have the notice like the police limit the party is bogus party, and I have submitted all my documents regarding I even submitted my e-way bill, my invoices, everything, but the GST officer is like there's no supply of goods happening there. So how am I supposed to answer the notice in that case? Because the invoice was being even reflected in 2B, 2A both way.
So you are saying that your vendor has stopped paying GST after your purchases happened.
Right.
So when in May 22 you did the purchase, that time he was filing 3B.
Yeah.
So apparently he must have paid,
Yeah.
and based on the provisions, and only after like recently in 23 they have stopped filing there.
Right.
I think you have a good case to fight out. The authorities at lower level may not accept that, but you can say that all section 16 provisions have satisfied, And section 41 also is not applicable on me because the period of dispute is of May 23, and I have taken the credit of May 22. So nothing in the law is barring me to take that credit, and it should be allowable according to me. And I'll come to another case study like burden of proof. I'll come to that. But in your case, you are also saying that e-way bill and all those details are there, lorry receipt, so you are able to justify the movement also.
Yeah, right.
Correct.
I even have the bill regarding the weighing machine. Like my goods are being weighed also.
Correct. So your case, to my mind, is strong on merits, and it can be argued. Maybe at lower level they may not listen, but in appeal stage it should come through. Sorry.
First level they will listen.
Generally they may listen, depend upon how officer is. At times some officers are very pro revenue and they pass judgments which the revenue will like. But some officers are really good and we get good cases, like we have seen even in service tax and excise. Experience with state GST appeal is little poor. Like generally the judgments are against. But central we see that we get a lot of favorable decisions. But again it is depends from officer to officer. Whether he is sitting on a retirement. Sometimes they don't want that their track record should get damned distorted. They feel that if I pass a very aggressive order, somebody may view it that how he has passed a favorable order, and they don't want to bite that bullet. So again it is very practical thing. It can't be said that every case will get resolved, but yes, broadly I believe it should get resolved. Yes.
Similar issue has happened with my client also. But what we have given the submission that you have not taken the transporter statement also, the goods movement have done. And then third party confirmation cannot be relied upon. And thirdly, we have taken that that stock, you must come and stock valuation must have been done from your side also. So this 2-3 points also have been added by us. So let's.
Yeah, I think this is a fair submission. And we'll have to see.
The same thing, e-way bill was there, everything was there. So.
Your inventory records.
Yeah, they must value the inventory records also, no?
Correct. That there was a GRN.
Yeah.
There was NP. Because you are lucky that in your case you are getting all these details. Because practically people just feel like invoice and payment details hai, so they will fly. It is not like that. Now they may go a little more deeper in terms of evidence, and we should have that. And I have a case study around that as well.
One more, can they rely on the third party confirmation? So can we take this stand, force this stand? Third party confirmation.
Third party means who? So anybody who is involved in the transaction.
Yes.
So if my transporter statement I have, who has on oath said a particular thing that मैंने transport किया है, so yes, that can be taken in our favor. So that can be taken. Yeah. So as you were rightly posing the questions, I am taking this case study of burden of proof. Company A purchased goods from vendor B. Company A has following documents: tax invoice, bank payment details, and invoices also appearing in to be statement. The GST officer in course of audit is insisting to prove whether ITC availed is genuine or not. In spite of I have given all these 3 documents, he's still gone ahead and saying that you prove that still the credit whether it is genuine or not. Whether he can do that? Yes, he can do that if you go to the Supreme Court judgment. So if you see section 155 of the GST Act provides that the burden of proving the claim of eligible ITC is on the claimant. So you have to discharge that burden. Now, how I discharge that burden? Can I only say that I've given you the tax invoice, it is in 2B and there is a bank payment details and therefore the burden is discharged? Traditionally, yes. Like if these three things are given broadly, things get satisfied. But in some cases, it may go little complicated. The officer may want some more details around movement of goods like e-waybill details, lorry receipt, inventory records, etc. And in this case, unfortunately, there is one Supreme Court judgment in context of Karnataka VAT, Ecom Gill Coffee Trading Private Limited. So here, like we have 155 in CGST, there was section 70 in Karnataka VAT Act, and the officer denied VAT set-off on the ground that the assessee has not substantiated its claim, and the assessee kept arguing that I have provided all the details and what else is required. So here, Ecom had purchased certain goods which are now deregistered. They had not filed returns. Same story, denied turnover and have not paid any tax. So they have not declared so much of sale as much they have made to Ecom, that vendor. So officer set aside the set off. However, the tribunal and High Court allowed the set off, stating that valid tax invoice and payment details are there. So till High Court, no problem. But the matter went south in Supreme Court. So I have again laid down what Supreme Court has observed in case of Ecom Gill. So burden to prove genuine set off lies on the claimant. Merely the fact that claimant is bona fide purchaser is not enough and sufficient. Means this is not sufficient. Merely producing tax invoice and payment proof is not enough and cannot be said to be discharge of burden. The dealer claiming ITC has to prove beyond doubt that the actual transaction which can be proved and it can be proved by furnishing the name and address of the selling dealer, details of vehicles which has delivered the goods, payment of freight charges, acknowledgement of taking delivery of goods, tax invoice and payment particulars, etc. It is not an infinite list. I may produce all this and still officer will still say कि मैं satisfy नहीं हुआ. Why? Because the supplier is deregistered or he has not filed the returns, right? So Supreme Court is going ahead and stamping on this burden of proof, saying that all these details are required. Now practically in your two cases, these details are there, but just imagine a huge company having pan-India operations, and at times there are legacy systems or the ERPs are not those robust that all these details are interlinked. Like in a statement of purchase register, I will get my e-waybill detail, I will get my GRN details, I will get all these details. It is not practically possible. So while theoretically I feel कि हाँ ये सब दिया जा सकता है, ये तो सब होता ही है कंपनी में, but practical challenges are there at times. After 5 years or 6 years, if you have to submit, you are not able to submit. Like even now, when we go to audit and assessment, we just keep saying to the department, we'll produce you 183 certificates and declarations. But after 2 months, 6 months, still we are not able, because company has so much of workload. They will file their routine compliance or they will run after these certificates and this. So there are these challenges. Then purchaser shall have to prove and establish actual physical movement of goods, genuineness of transactions by furnishing all the details mentioned above, and merely production of tax invoice and bank details is not sufficient. And the tax officer is justified in denying the input tax credit. Now this ratio can be applied even under GST. So we should be prepared in coming days that till now they were only pressing on mismatch and all that. But now after everything is matching, like in your case, they'll go ahead and ask for these details. So if e-waybill details are not downloaded in timely manner, I was told that that report is available only for 6 months. After that, it goes out from the portal, and from nowhere you can find out that. And at times you're not using technology, like one software where everything is put together, like GSTR 1, 3B, your reconciliations. E-way bill is also generated from that. So that system only will do reconciliation of one and e-way bill. So all those things and invert side e-way bills are to be downloaded. All those things are not done. If it is not done and it is not that robust, it will be very difficult to face the assessment. And now the Supreme Court itself is saying कि ये सब लगने वाला है.
But sir, in that case, they have blocked my IGST ITC. I can't take my IGST ITC unless and until I don't answer to that notice. Is that allowed? Can they block my ITC?
Yeah, I think now after this DRC 01C, there is one 86A also, which allows them to block the credit, but I will have to see which provisions can be invoked to block, because DRC 01C, the liability gets triggered in 3B, it gets added. Blocking is from 86A, and there is a lot of conditions by which blocking can be done, and it is for a particular time period. It is not eternal. So I think it is 1 year. So in one of our clients' case, they were not unblocking it. So writ petitions have also been filed, and there are judgments to say that blocking cannot be done randomly. Firstly, there has to be some cogent reason, and even if it is blocked, it is for a particular time period. Now, whether ITC can be taken in GSTR 9. So we have like very interesting arguments. I have never even thought that these kind of arguments can also be made, and high courts are entertaining such kind of arguments. So Madras High Court, I think, is like forefront in issuing very good judgments. Shri Shanmuga Hardware Electricals is a SSE. They never claimed any ITC in their 3B returns. Okay, so technically 16.4 gets triggered, and they are saying they took the credits in GSTR 9. They have the tax invoice and all payment details, all details are available, and GSTR 9 also should be considered as the return to avail the input tax credit. And the High Court has gone ahead and issued the writ order remanding the case back to the assessing officer, and they are saying that department should verify the ITC claim based on the documents provided. So even though 3B में 0 है, 9 में डाला है, and they are saying you can take the credit. In a way, they are suggesting, while the order is not very speaking order, and this is the space which we will have to watch out for. In my personal view, 3B is the return notified for availment of credit, and that can be taken, credits can be taken only in 3B. 9 is consolidation of what is there in 3B. It is not a return in itself. It is an annual return consolidating 3B. So, and also if you see this 30th November timeline which came, so there was a debate going on whether I can take credit up to 30th November or any 3B which is filed up to 30th November. So there is a circular, and generally a view is being taken that credit can be taken in 3B returns only, and the latest 3B which is filed before 30th November is of October. So technically, even though the due date has been extended till 30th November, credit is taken only till October, 31st October, and then it is reported in 3B of October. So this judgment, I don't know how much it will stand. It is one of the judgments, but in case anybody is not done and they want to take such arguments, assuming they have gone ahead and reported correctly in 9, this kind of argument can be explored, but honestly I'm not sure how much how this judgment will go, and whether any Supreme Court appeal has been filed. We'll have to watch out for this space. Another case study I have taken based on my practical experience: movable versus immovable property. So New Limited, so the case study is that New Limited has recently planned to start its software development business in Pune. It has identified a leasehold premises for the same. The company is planning to enter into a turnkey contract for setting up the office. So maybe if there is an existing office of the old tenant, they may get it demolished, completely removed, and do up the entire false ceiling, paint, carpet, movable furniture, then maybe AC system, fire alarm system, access control systems. All this will be done. There are many things in terms of activities. Architects are there, project management agency are there. So varied services are being used to set up this office. So the company is seeking advice about availability of ITC in respect of said expenditure. Now, can the company avail the credit? Because 17.5 there are these two sub clauses which says that ITC in respect of any works contract service for construction of an immovable property or ITC of goods or services for construction of immovable property is not allowed, provided they are capitalized to the asset for which this credit is being taken. If it is not capitalized, we'll have to see. And they have defined what is an immovable property. They have defined to which aspects this will not be applicable. So it is not applicable to plant and machinery and any foundation which is there for the plant and machinery. But they are saying it is credit will not be available in respect of buildings, civil structure, pipelines outside the factory. Now, in this background, can anybody give a point of view whether the company can claim ITC of these setting up of the new office or not?
For AC system, in my case, the officer has deliberately not allowed the ITC. He is saying that the AC is not a plant and machinery; it's an assembled system. So he said that he 17 subsection 5 he disallowed the ITC of air conditions.
Okay, air conditioned system.
Yeah. So is it? It's not plant and machinery. It's an assembled system.
But I think in income tax block of assets, it will be capitalized under plant and machinery. To my mind, to my mind, there is lot of material.
He actually said that Mumbai BMC in certain case BMC also identified that the AC is not a plant and machinery. AC is an assembled system. He also quoted Gujarat advance ruling. In that also.
No, but any plant and machinery has to be assembled. When we say a plant, it is a component or combination of multiple things. It is not one single machine. Therefore, it is called as a plant. And to my mind, AC plant will qualify in the definition of the term plant and machinery. We'll have to find out some supporting judgments to that, and what they are saying, Bombay Municipal Corporation, in which context, for what purpose they are saying.
Works contract case. It is defined whether that contract AC installation is a works contract or not. That is a different case. It is not related.
He only said that AC is not a plant and machinery. It's an assembled system.
But what is denied in section 17.5 is only land and building. It is not a building. AC is not a building. What is denied is a building. Can you say AC? A building can be only with AC.
His contention is that if you do not attach that AC to the building, it will not be workable. So it's parting of that building. This is his contention.
So even elevators and all that are what is part of building and what is not. That is a matter of detailing. To my mind, in this particular case, the credit should be allowed. Now, in our case, it is a turnkey contract, right? So it is a combination of everything. The case study I am saying. So whether credit can be allowed in this case, or they can say it is a works contract for construction of immovable property. Construction includes renovation also. So to my mind, instead of having a turnkey contract, it is better they have, like from a good planning point of view, they have separate contracts for different aspects. So like AC, fire extinguisher, access control software, they should have a separate contract. All movable furniture, they should have a separate contract. That is how they can optimize the input tax credit. And what is movable, what is immobile is a very debatable topic in that sense. In one of the IT companies, we had advice, like we did a detailed analysis of what all things are there, and we analyze each item, like whether the glass partition is immobile property, whether this hanging lights are immobile property, carpet which is fixed on the floor, whether it is an immobile property, and we analyze each and every item, and accordingly we opined on the availability of the ITC. So here I have one important thought. So if you see explanation to clause C and D of 17.5, I am reading out the bare explanation. For the purpose of clause C and D, the expression construction includes reconstruction, renovation, addition or alteration or repairs to the extent of capitalization to the said immobile property. Now the facts of case study is that immobile property is not mine. I have taken it on rent. So there is no capitalization of such immobile property in my books. There is no building, land and building as such any item in my books of accounts. So can I take aggressive arguments saying that there is capitalization, but it is not to the said immobile property, because that immobile property itself is not existing in my books. So I can go ahead and avail ITC of everything. But this is in contrast to a case where I have my own land and building. I have capitalized that building in my books of accounts. So I would say that this explanation will hit those kind of taxpayers. But a typical office who has taken the lessee kind of a scenario, this explanation may not trigger. So this is something we can argue, but unfortunately the client was MNC and they didn't wanted to take any aggressive position. They were happy to reverse certain credit or not avail the same. But if the amounts are big, this kind of argument, to my mind, can be explored. Then, if you see, if it is not capital expenditure, if it is debited to P&L, definitely credits in that case can be taken. At times, people just look at immobile property and then they start saying credit nahi milega. But they fail to understand that the condition is on capitalization of that expenditure to the immobile property. So if I am doing routine repairs of the building, कोई bathroom में tile fix किया है and painting चल रहा है, and if we see that the company based on its accounting policy is not capitalizing that expenditure, then ITC should be available. So we should not be in that case afraid of taking because it is in relation to immobile property, because it is not capitalized. Yes.
If we do any construction related work and expenditure incurred in the books is direct transfer to the P&L.
Correct.
Then we'll take the credit.
Yes. Because 17.5 C and D and that explanation which I read out just now, it talks about to the extent of capitalization. So capitalization nahi hai, so that clause doesn't get triggered.
Irrespective of the nature of that work.
Correct.
Just P&L को hit किया.
So P&L को hit किया means basis some accounting standard and auditor is also approving. Just to take the credit, everything is going to P&L is not permissible. So to my mind, if such expenditures are there, practically we can go ahead and take the credits. Then what is movable and immobile? I said it is a highly debatable topic. So there is this judgment of Triveni Engineering, celebrated decision under excise regime of Supreme Court, and solid and correct engineering, and they have laid down these tests which have been repeatedly taken by Supreme Courts in various judgments. It talks about mobility, marketability, and test of permanency. So mobility can be determined by checking whether an article is permanently fastened to anything attached to earth, and whether there was intention to fasten the article to anything attached to the earth. Then marketability test requires that goods as such should be in a position to be taken off to the market and sold. And test of permanency, that if the chattel was movable to another place of use in the same position, then it must be movable property, but it was liable to be dismantled and retracted at the later place, then it would be treated as permanently attached to earth. So say a machine is there which is like bolted to the ground for operational efficiency with nuts and bolts. Just because it is fastened to earth, it doesn't become an immovable property. It will be still a movable property. If you remember Sirpur paper mills case, that machine was grounded and it was bolted so that it doesn't wobble at the time of operations. So that kind of machine, they said it is not an immovable property. But there was some Bombay Municipal Corporation case where this test of permanency was there. So there was a huge petrol tank, like it was a very giant structure. It was not even bolted to the earth, or they were not even fastened. It was just lying on its weight on the ground, but it was huge. It was erected over the period of time on that ground. So, but if it had to be moved to another place, because of the sheer volume and size of that tank, it had to be dismantled. So, and therefore the even though it is not fastened, there is nothing, no cement, nothing, no bolting, the Supreme Court in that case had held that it is a immovable property, because it can't be shifted as it is to another place. So there are judgments which are contradictory, but some of these landmark judgments we have to refer to determine what is movable and immovable. That itself is a very detailed topic, if you can see. And another important aspect to watch out for is this Orissa High Court judgment in Safari Retreats case, where this clause C and D of 17.5 have been challenged as unconstitutional. And if you see, this was there even under Senvat credit regime. It is not that it is a new baby in GST. Even these provisions were challenged in service tax regime, nothing happened, or Senvat credit regime. But Safari Retreats, the High Court, Orissa High Court upheld the constitutional challenge and said that C and D cannot deny me the credit. It goes to the basis of the GST, that is against the basis of the GST, that GST is to avoid cascading effect of tax. So there cannot be any tax on tax. So here they have allowed the credit in relation to construction of immovable property. And the matter is now pending before the Supreme Court. Hearings have already happened. The judgment can be pronounced anytime soon. So practically, if you see in most of the cases, earlier availment itself was a punishable offence and interest was applicable on mere availment of ineligible ITC. Now if you see 53 and all those are providing that interest will be available only if ineligible ITC is utilized. So in cases where clients have significant amount of such ITC, or as an abundant precaution, we can keep that amount in balance and not avail that ITC, and wait and watch as to what Supreme Court has to say. While with due respect, there is an opinion that Safari Retreat is a very cryptic judgment and it is not drafted properly. But so it is a High Court decision, and in that case it is right now in the field. And Supreme Court has not stayed the operation of the judgment. Means Supreme Court may have found some merits and therefore they have not stayed this judgment. So this judgment is still alive and we have to watch out for this space. So that is how we can look at this immovable property. There can be many more aspects to this provision, but right now with paucity of time I am covering only some of the things. I think we have only 10 minutes left to complete the session, correct? So I'll quickly rush. There are many more case studies. So company Z is engaged in supply of taxable service. it does not have any exempt supply. Company Z is availing full ITC and is not doing any reversal of ITC. Then company A occasionally invests its excess fund as a part of treasury management function. They may park their excess funds in FDs, at times in shares and mutual funds. So and then they are selling the shares to unlock the profits, and the department is now saying that they need to reverse ITC in respect of these shares being sold. Is this correct?
Yes.
Yes.
73.
Sir is saying no. Yes, so if you see 17.2 mandates reversal of ITC attributable to exempt supplies, and if you see the definition of term exempt supply, it talks about goods and service. So secure or both. Securities or shares are never goods or service. So that way it is not an exempt supply. It is not even a non-taxable supply, because non-taxable supply in 278 also talks about goods or services or both. But 17.3 they have stated that for the purpose of computing the exempt supply, value of securities as may prescribed needs to be added. So only for purpose of reversal of ITC, they are saying that value of shares needs to be added. And then there is the rule explanation to chapter 5 of ITC in CGST rules, which says that for determining the value of exempt supply as referred to in section 17.3, the value of security shall be taken as 1% of the sale value of such security. So ideally ITC reversal can get triggered because of specific provisions in 17.3. We have observed that many companies or clients fail to do this reversal during their routine proceedings. But here one more twist I want to add, whether mutual fund if I am invested in, that can also trigger this reversal, because the value while 17.3 says that sale of securities, right? Now say mutual funds, I invest the money and then I redeem to the I don't buy and sell like how I invest in Reliance shares. I buy on the stock exchange, I sell on the stock exchange. But mutual funds, I am invested in Nippon mutual fund scheme 1. I invest and then at on a particular date I may redeem that. I don't buy and sell that. So can I argue that this provision doesn't apply to mutual funds? I think it is possible to argue that if you have not done the reversals already and you are getting some show cause notice, this kind of argument can be taken. But practically people are doing reversal even in case of mutual funds.
But it will be applicable only for common credits, na? Common credits. Which is
Correct. Common credits and
whatever
anything
is directly attributable.
directly, whatever is attributable, you can't take the credit, plus only to the extent of common credits. Now what is common is again a debatable thing, because you have 10,000 square feet of office and the treasury person is sitting in one corner occupying a particular one desk. So whether the 100-seater office can be considered as common, or that only one desk area can be considered as common. So how to determine common itself is a challenging task, or identify that. Practically it becomes like telephone, courier, security, AC maintenance, how much you attribute to that as a common thing is something one has to determine. Slum sale of business. So in this case, Star Private Limited is engaged in supply of taxable services. They have one industrial division and another is the retail division. Recently, Star Private Limited, by way of an agreement to sale, sold their retail division as a going concern to another entity, and Star doesn't have any other exempt supply, and Star Limited is seeking your advice whether it is required to do any input tax credit reversal in this case. Just to invite your attention, this transfer of business as a going concern is a exempt supply, because there is no exemption notification under the GST provisions. So that particular aspect is exempted from GST, and therefore can somebody say that this is a exempt service because it is not a goods, as Preetham was also saying, anything other than goods can be service. Department can say that, and therefore it is an exempt supply, and hence ITC reversal under 42 is applicable. Why?
It is not covered under sale. There is no particularly supply of service as such in this transaction. It is totally transferred as a business going concern, including assets and liability.
Correct. Business as a whole is transferred. Now whether it is goods, because so then if it is not a service, then why there was an exemption notification issue? Department is always, like, we are facing this show cause notice in service tax regime. They are asking for reversal of SENVAT credit for such transfer. So there are multiple open issues. How I report the transaction? Should I report it as an exempt supply in GSTR1? If I have pan-India operations, how do I split the slum sale consideration if it is a net asset value, say 50 crores? So I have assets scattered across the country. So which all states I report this consideration, and whether ITC reversal is required. I think we can take a stand, like most of the companies have not been reversing, but department may come to bite us for such things. The possibility of argument here, as you rightly said, that this is not a service. Merely because there is an exemption notification, that doesn't mean it was taxable in first place. It was not even taxable. You just gone ahead and issued an exemption notification that will not create a levy. So exemption notification cannot create a fresh levy, and therefore it is, when it is not a supply of goods or supply of service, it doesn't fall in ambit of exempt supply, and it is not even a case of non-taxable supply, and therefore ITC reversal may not be done. Practically, companies are not taking ITC of specific services like valuation, lawyer services. They are not taking, but common ITC they are not reversing. And if you see the SENVAT credit rules, Rule 6.3 and the calculations, at least there was little leverage where you could do the computation for a particular month. Say that the slum sale has happened in March, then you can reverse common ITC only for March. But if you see, there was a possibility to interpret that way, 6.3. But if you see 42, there is a difficulty in interpreting. So if you, in that way, so you have to do the common credit reversal for entire year. So even if the transaction is done in March 24, you have to identify a common credit for the full year, and then you have to do the reversal. There is no pro rata monthly kind of a formula which is there. So practically people have not done, but I can say that some once the department picks up this issue, they might come behind the assessing.
But what is necessary to show in GSTR1, or should we show in first place?
First you see how much is your ITC reversal.
No. I don't want to reverse my ITC.
No, but moment you show, then you will go. Because moment you show it as an exempt supply, then if you have not done an ITC reversal on the ground that it is not an exempt supply in first place, then don't report in GSTR1. But दिखा दिया तो आप फंस जाएंगे, because then he will say कि exempt supply तो आपने बताया है, फिर reversal क्यों नहीं किया? Rule 42, 17(2), Section 17(2) trigger हो जाता है. So if you are taking one particular stand, then you keep that stand constant.
I was saying that I will show in the no supply, I mean no non-GST supply or no supply. Because it is not even supply. So where the question of reversal comes. But so in that case, if I say that I am having a salary, I am a salaried person and I am getting the 2 crore का मेरे को ये मिल रहा है. What I can say, 2 crore का salary and I am getting 2 crore rent. Now whether my 2 crore salary will be entertainment, I mean if I show it in no supply.
No, but you must have taken registration for a renting business, huh? You have not taken it for a salary.
Yeah, I have taken renting business.
Practically, I would suggest not to report it, because moment you report, then you are gone. You will keep explaining and whatever is not there in their minds, it will start coming. Yes.
Even if we read rule 40 to 43, where the reversal calculates for exempt supply, and if we go to the definition of exempt supply, it includes non-GST supply and no supply. So if we report, yes, I am agree with you. If we report, we will fall into trouble.
I am saying it is not even a non-taxable supply, because if we maintain that analogy, that business per se is not a service. So anything other than goods is a service, but it cannot, as Preetham rightly had highlighted today, that is not unlimited section. So moment I said it is not, it is definitely not goods. If I argue that it is not even a service, then it is not forming part of non-taxable supply also.
Yeah, even I will go against it. See, if I will have a second thought on it. Even if it is a service, for example, I will go on that contention, since I am shutting down this business. So it is not in the course or furtherance of business. Hence, even if it is a service, it is not a supply taxable transaction.
No, but moment you say it is not in course of furtherance of business, you will get trapped in 17.1, section 17.1. So you will have to, correct, but you will have to then prove that there is no credit which is used towards that. But practically, there could be some extra telephone call, some extra courier, other major service remain the same.
Maybe for that transaction consultancy fee from chartered accountants.
So that people are not taking any which ways. Directly, whatever is there may not be taken.
But what about the assets which are going into this slum sale, on which ITC is already claimed? Now, even though if you may call that slum sale is not a sale or something like, there is another provision, is a disposal of assets which are already ITC.
So now so there my point is that what you are selling is not an asset. You are selling business as a going concern. So there is no, the asset individually loses its character. And the idea of giving exemption is that, so there I will utilize the exemption, and that it is exempting this supply. So now you can't tax it by invoking that schedule 2, you are saying, schedule 1, sorry. So you can't, because there is no independent supply of asset. If you are doing itemized sale, then maybe you could say that.
But in my books, I have to pass the entry that way. My assets will be reduced, disposed of from my listing. Even that entry, if I think it is in schedule 1 or something there, that even it is without consideration, it will attract this issue.
Yeah, but
disposal of asset.
Correct. But what I am saying is I am not disposing the asset. That is going as a effect of transfer of business. So what I am selling is business as a whole, as a going concern. If I was transferring the asset, that output supply itself would have attracted GST. Am I paying 18% on that? Reversal will be there when there is no supply. If you are saying that there is a supply of asset, then definitely there is a consideration also. So in my example, if I have received 50 crore or 50 CR, then some pro rata amount is attributable to that asset also. Then why should I not first pay tax on output supply?
But according to me, in this case, what you are saying is the allocation of consideration to that asset. But if you refer that particular entry, in schedule 1 it is there, in my knowledge. So if it is even without consideration, even if you just write off, you purchase let's say some asset, you use it for 2 years and now you are writing it off. As per that rule, I think the 5 years, 60 months it is calculating, and proportionately for 36 months you will have to reverse that ITC because you are disposing it off or writing it off.
So schedule 1, that entry which you are referring, permanent transfer or disposal of business assets where ITC has been availed on such assets, activities to be treated as supply even if made without consideration. Firstly, I beg to differ. I am not doing asset transfer of asset per se. I am transferring the business. And secondly, schedule 1 will get triggered only if there is no consideration. In my case, there is a consideration which is lump sum. So if I have to take your argument forward, then why would I reverse ITC? I will have to pay tax on output. Taxable supply ho gaya na, but I am not independently, if you see buyer and seller agreement, they are not independently requiring the asset. they are saying मेरे को business contacts चाहिए, know-how चाहिए, running business चाहिए. तो what I am doing is a whole thing.
Exactly. Then let's say, for just sake of argument, I will say that you have not got any consideration for the asset, right? You have got the consideration for the running business entity that you are saying.
Which include asset also.
Right, which include asset also. But you are disposing and you are not allocating any consideration to that. So that's why this provision may get triggered. It's a
No, in my view, it doesn't get triggered because I'm selling a running business, and the Schedule 1 entry will not get triggered, and I will not be liable to reverse ITC on that asset. So there are more case studies, but I will take a pause. I have taken CSR activities and all that, but I will take a pause here. Maybe remaining case studies we can cover later.
We can send this PPT to
Yeah. So any questions?